Hello everyone, welcome back to another episode of Mark Talks Finance. Now, if you're just getting started into investing, there's no doubt that you've heard the word ETF thrown around quite often. A lot of advice to new investors is usually buy an ETF, buy a market ETF, buy a sector ETF. But what exactly does this even mean? And how do I go about buying an ETF? And what ETFs should I consider? Well, we'll look to answer these and much more in today's episode of Dragon Ball Z. Well, in today's episode of Stock Market Defined, what is an ETF? And with that said, let's get right into it. So what exactly is an ETF? An ETF is an exchange-traded fund, which is a type of security that tracks an index, sector, commodity, or other asset, but can be purchased or sold on a stock exchange, just like a regular stock. An ETF can contain many types of investments, including stocks, commodities, bonds, or a mixture of investment types. And it's often called an exchange-traded fund because it can be traded on an exchange. Yeah, I know, sounded obvious, but that's what it is. It's a collection of stocks that can be traded on an exchange just like a stock. Now, this allows it to have the advantages of a stock and eliminates the disadvantages when compared to an index fund or a mutual fund, for example. By the way, look out for a video on indexes to come later. Now, an ETF can hold thousands of stocks spanning various industries, or it can hold a few stocks in a particular industry or sector. There are a lot of options when it comes to ETFs. So the question is, why would you use an ETF? Well, an ETF can be used to gain exposure to multiple underlying assets. So unlike a stock, which only gives exposure to one asset, you get exposure to hundreds or thousands of underlying assets for the price that's comparable to that of one singular stock. Also, because there are multiple underlying assets within an ETF, this makes an ETF a strong choice for diversification within your portfolio. Another reason is that ETFs can be used to set up for income generation, which is never a bad thing, as there are lots of fixed income ETFs on the market to choose from. Okay, now that we're familiar with what an ETF is and why you would want to use an ETF, let's now move along and take a look at the types of ETFs that are available, and this hopefully will start to get the wheels turning as you start to figure out what type of ETF could work for you. All right, let's take a look. First on the list are index ETFs. Yes, that's right. There are ETFs that track an entire index. And these type of ETFs are arguably the most popular and the most recommended, especially to those who are just getting started in their investing journey, or those that are not at an advanced level yet. Now, the main advantage of these ETFs is that since they track an entire index, they offer the most diversification and the most downside protection in a bear market. Now, this does not guarantee that you will not lose money. However, it does offer the least exposure to losses, and this is because of the level of diversification that you have. Examples of index ETFs include VOO or SPY, which tracks the S&P 500, and these include the largest 500 companies. VTI, which tracks the entire stock market, or QQQ, which tracks the NASDAQ 100. And the NASDAQ 100 typically contains technology stocks. Next, we have industry ETFs. Now, industry or sector ETFs are funds that focus on a specific sector or industry. For example, a technology sector ETF will include companies operating in that sector. The idea behind industry ETFs is to gain exposure to the upside of that particular industry by tracking the performance of companies in that sector. At the same time, the downside of that sector is also captured in that ETF. So if you're heavily invested in a sector ETF, your portfolio might appear to be down while the rest of the market is up due to that particular sector going down, or due to a sector rotation during economic cycles. Next on the list, we have bond ETFs. Now, bond ETFs are used to provide regular income to investors, and the income depends on the performance of underlying bonds. Now, this could include government bonds or corporate bonds. Unlike their underlying instruments, bond ETFs do not have a maturity date, and they generally trade at a premium or discount from the actual bond price. Moving on from bond ETFs, we have commodity ETFs. As the name implies, commodity ETFs invest in physical commodities, for example, gold or crude oil. This provides several benefits. First, they offer diversification as they track a commodity rather than a stock, which can provide a cushion during a stock market correction. Second, holding shares in a commodity ETF is cheaper than physical possession of the commodity. If you hold a commodity directly, this usually involves storage fees, insurance costs, which you won't have to worry about if you have a commodity ETF. And lastly, we have leverage ETFs. Now, leverage ETFs have somewhat become popular lately, and these attempt to earn gain from the stock market price movement by using leverage to bet that the market will either decline or go on a bull run. Now, word of caution on leverage ETFs, because this is probably one of the most dangerous ETFs to dabble in, because while this can double or triple your gain, at the same time, it can also double or triple your losses. So imagine this. If you have a triple leverage ETF that was tracking a stock, right? If that stock goes down by 1%, your loss in the leverage ETF will be 3%. If it goes down 10%, your loss will be 30%. So if the stock goes down 10% every day, which is not uncommon for a stock to go down by 10%, your entire investment can get wiped out. Now, lots of new investors are attracted to leverage ETFs because of the potential multiplier for gain. But in reality, many of people lose money. So it's probably best to leave this one alone for the professionals. Okay, now that you have an idea of the type of ETFs out there for you to invest in, you want to consider the following steps when getting started with investing in ETFs. First, you want to look into investing platforms. ETFs are available on most online brokerages and trading platforms, and some of these platforms can distinguish your services from others through convenience and product variety. For example, some platforms excel at smartphone investing apps, which enable ETF share purchases at the click of a button. Some platforms offer commission-free trading on ETFs, meaning that you don't have to pay any fees to buy or sell ETFs. Examples are M1 Finance, and if you're in Canada, Wealthsimple offers commission-free trading, and if you sign up using my link below, you also get 2 free stocks. Not 1, but 2. Just from signing up using the link below. You get 2 free stocks, and it lets Wealthsimple know that I'm doing my part in spreading the word. So if you can do that, you get free stocks, I get free stocks, we all get free stocks, everyone wins. Now, the next and most important step is research. There are literally thousands of ETFs out there for you to choose from. And you need to consider things like whether you're investing for income or growth, what your time horizon is, any sectors are of interest to you, and whether it would pay to go with a dollar cost averaging strategy, or if you want to rotate in and out of different sectors to take advantage of market momentum. Even though the rotating strategy is more for more experienced investors, so I wouldn't dabble in that right now. Now, let's talk a little bit about the pros and cons of ETFs. Now, a key advantage here is that you get access to various stocks across multiple industries at a low cost, as opposed to buying each stock individually. This also lowers transaction costs, especially for brokerages that charge commissions per transaction, as you will only need to make one transaction for the ETF, rather than multiple transactions for the purchase of each individual stock. Another advantage of ETFs, which is the most apparent, is of course effective risk management through diversification. Now, if you're investing in multiple companies, there's a slimmer chance that you will lose all your investment if one company was to fail, for example. This will also help to limit the downside of your investment in a bear market, although there's a scenario to watch out for, which I'll cover in a minute. That's it for advantages. Now let's look at some cons of ETFs. Now, a con or a disadvantage to look out for is the high management fees. Some ETFs can have a higher expense ratio due to the type of management. So for example, if the manager will be actively buying, selling, and changing the holdings within a fund, that ETF will come at a higher fee to manage. So make sure you look at the cost versus the rate of return to determine if a certain ETF is worth holding. Also, another con to be mindful of is buying an ETF that's focused on one sector. You might see an ETF that gives high returns due to it being in a certain sector, and this might be appealing to buy into. But even though the ETF holds multiple companies, there's still a risk that you can take heavy losses, especially if that sector as a whole crashes. An example of this would be the travel airline sector or the real estate sector. Now, if you were invested exclusively in an airline ETF or in a REIT, you would have taken quite a hit in 2020. You can offset this by simply investing in another ETF that's not limited to one sector. So keep in mind to make sure that you're not limited to one market sector with your ETFs. With that said, I'll bring this video to a close. Hopefully you've gained some new insight on ETFs to help you with your decision making. If you found this video informative, drop a like down below as it helps the algorithm and gives this video more exposure. Also, if you have any comments, questions, or just want to say what's up, feel free to drop a line down in the comment below. Once again, thanks for watching, and I'll catch you in the next video. Peace.